Welcome back to the Deep Dive. Today, our mission is really to cut through the noise around the Cigna Group's latest earnings, Q3 2025. We've got the usual stack of sources, financial filings, the prepared remarks, Q&A transcripts, and the numbers. Well, they tell a pretty interesting story.
They really do. But, the actual deep dive here isn't just about the top-line revenue. I mean, yeah, Cigna delivered strong financials.
Right.
But the real story, the strategic focus, it's all about this massive, proactive transformation they're undertaking with their Evernorth pharmacy benefit services business.
I'm not just tweaking things.
No, not at all. This is more like a fundamental redesign. They're aiming to, future-proof the whole platform because that PBM market is under some intense scrutiny right now.
Okay, so we're looking at a company that feels maybe confident enough in its base business to actually take a bit of a short-term hit for what they see as long-term stability. And the question for you listening is maybe whether this big pivot is, I don't know, the start of something bigger, like a fundamental shift across the whole PBM sector. #CheckNileI. The Q3 2025 financial scorecard and outlook. All right, let's set the stage with those financials then. They kind of frame this whole strategic chat. So for Q3 2025, Cigna reported adjusted earnings per share EPS of $7.83.
$7.83.
And total revenues hit $69.7 billion. That's a solid 10% increase from Q3 last year, 2024.
Yeah, pretty strong growth. And that performance basically gave them the confidence to reaffirm their full year 2025 outlook for consolidated adjusted EPS. They're sticking with at least $29.60.
Okay.
And this financial strength, it really comes from their pretty balanced business structure.
Yeah, that structure seems key, especially for understanding where maybe the growth and the pressure points are going to be going forward.
Yeah.
How does that enterprise earnings pie actually look right now? How's it sliced up?
Okay, think of it basically in two main buckets. First, you've got Cigna Healthcare. That's the biggest piece, roughly 40% of the total enterprise earnings.
30%. Got it.
Then the other 60% comes from Evernorth Health Services. But Evernorth itself is kind of split almost down the middle into two big businesses.
Okay.
You've got specialty and care services that brings in about 30% of the total enterprise earnings. And then the pharmacy benefit services, the PBS business we were just talking about, that accounts for the other 30%.
So 40, 30, 30, that's a helpful way to think about it. Spreads the risk around.
Pretty much.
And even with this big investment they're making in that 30% PBS chunk, management still thinks they can deliver overall EPS growth in 2026.
That's the core message, yeah. They're banking on strong growth from Cigna Healthcare, that 40% piece, and also from the specialty and care services side of Evernorth, the other 30%.
Okay.
And they expect that growth to more than make up for the headwinds they know are coming specifically for the PBS business next year in 2026.
So they're being upfront about it.
Very transparent. They're signaling, look, one segment's going to dip temporarily, but the whole company, the enterprise, stays resilient. #tag2, the high cost of drugs and innovative solutions.
Okay, so this brings us right to the why. The strategic context. Why make this big pivot? I mean, the PBM World Pharmacy Benefit Manager, for anyone needing a quick reminder, it often gets a lot of heat over drug costs, right?
Oh, absolutely. Constantly. But their sources, Cigna's sources, they highlight something really important here, a nuance often missed. Generics. Generics in the U.S. are actually a massive success story.
How so?
Well, think about it. Generics make up 90% of all prescriptions filled. 90%. And thanks, in large part, to the competitive market that PBMs help create, the U.S. actually has the lowest generic drug prices in the world.
Really lower than elsewhere.
Often about 1/3 cheaper than in other developed countries. It's a huge win for affordability on that front.
Okay, but that success story kind of evaporates when we switch to brand name drugs, doesn't it?
That's the flip side. That's the crisis, frankly, that's driving this whole Cigna strategy. Brand name drugs in the U.S. cost, on average, 4 times as much as the exact same drugs cost in Europe. 4 times.
Wow.
And here's the really staggering stat. Even though branded drugs are only 10% of the prescription volume,
Just 1 in 10 scripts.
right, they account for a whopping 88% of the total pharmaceutical spend. 88% of the cost comes from just 10% of the pills.
That financial imbalance is just huge. And it explains why we see these shocking headlines about the list price of new therapies. I mean, the median price drug companies are setting for new FDA-approved drugs this year, 2025. It's projected around $390,000 for a course of treatment.
Exactly right. And when list prices get that high, the traditional PBM model, which, relies heavily on these post-purchase rebates to kind of mask those costs, it just starts to break down. It doesn't work as well for the patient or the payer.
So the rebates aren't enough anymore.
Not when the starting point is so astronomical, and that's why Cygnus is really highlighting these innovative, more immediate solutions. They used Humira as an example in their discussion.
Okay, the arthritis drug.
Yeah, very common, very expensive. Its list price is getting close to $85,000 a year now.
85,000.
But Cigna's pointing to an offering where they give customers access to Humira or its biosimilar equivalent at zero cost to the individual consumer.
Zero cost. How?
It's a specific program, likely negotiated differently, but the point is it's a direct intervention. It sidesteps that massive list price entirely for the patient in that plan. Hashtag tag 3, unpacking the transformative rebate-free PBS model.
That kind of innovation leads us right to the core of this strategic shift then. This new rebate-free delinked pharmacy benefit services model. It sounds like a very deliberate move away from that traditional, frankly confusing rebate system.
It is. Fundamentally, this new model is built on transparency. That's the key word. So instead of these complicated post-purchase rebates where money changes hands months after the patient actually fills the prescription.
Yeah, it's always felt a bit opaque.
Totally. Cigna's replacing all that with a simple upfront discount. They're moving to a straightforward fee-based structure. It just simplifies the economics for everybody involved, the client paying the bill, the pharmacist filling the script, and crucially, the patient.
Okay, so how does that transparency actually translate into savings for me, the patient, when I'm standing there at the pharmacy counter?
It's designed to eliminate that sticker shock or uncertainty. Under this model, the customer automatically pays the lowest available price right there at the counter.
Lowest available, meaning?
It could be their negotiated insurance benefit price. Or if Cigna has access to some other cash pay price that happens to be cheaper for that drug at that moment, the system gives the patient that lower price instead.
Oh, okay.
And here's the really critical part. Cigna ensures that every single dollar the patient spends, no matter which pricing mechanism was used, the benefit or the cash price gets applied towards their annual deductible and out-of-pocket maximum.
That is huge, especially I'd imagine for the, 30% or so of Americans now in those high deductible health plans?
Exactly. For those members, Cigna anticipates this new model will cut their out-of-pocket costs for a typical brand name drug prescription by an average of 30%.
30% lower right at the pharmacy.
Right at the point of sale. Those are real immediate savings, not some rebate check maybe coming months later, if at all.
Now, I also thought it was interesting that they specifically mentioned designing this to help independent pharmacists. They often operate on really thin margins, right? How does this new structure benefit them?
Yeah, that's an important piece. It aims to create more predictability for them. So instead of being reimbursed through these complex, often delayed formulas tied to opaque benchmarks.
Like average wholesale price or something.
Exactly, things like that. Independent pharmacists will now be reimbursed based on their actual drug procurement cost, what they paid for the drug, plus a clear dynamic dispensing fee.
Dynamic
Meaning it can adjust, but it's transparent. It stabilizes their income. And they even went a step further. Cigna committed to providing a higher dispensing fee specifically for critical access rural pharmacies.
Oh, interesting. Why?
Just acknowledging that it often costs more to operate in those underserved rural areas, it helps keep those essential pharmacies viable.
Okay, this sounds like a pretty major overhaul. When can we actually expect this new rebate-free model to start taking over?
It's definitely a multi-year rollout. You can imagine the complexity of recontracting the entire supply chain, right?
Yeah. Thousands of pharmacies, payers.
Exactly. So Cigna Healthcare, their own insurance arm, will adopt this rebate-free model 100% for all its fully insured members starting in 2027.
2027 for their own book of business.
Right. Then it becomes the standard offering for all clients, broadly in the marketplace, starting January 2028. And their goal is pretty ambitious. They want to transition at least 50% of their total PBM business onto this new structure by the end of 2028. Hashtag tag IV, Evernorth's strategic moves, and 2026 headwinds.
Okay, so this massive, complex transformation. It makes sense then why Evernorth leadership seems willing to kind of absorb some short-term margin pressure in that PBS segment. But before we dig into the cost of that transformation, we should probably acknowledge that the other side of Evernorth, the specialty and care services part, is actually doing really well, right?
Oh, absolutely. That segment, the other 30% of earnings we talked about, is performing exceptionally well. It delivered a strong 11% adjusted earnings growth just in Q3.
11% growth.
Yeah, and their specialty pharmacies, they're on track to deliver something like 7 million prescriptions this year alone, and that part of the business is still growing at a double-digit rate.
And didn't they just make a big investment to fuel that specialty growth even more? Buying Shield Health Solutions?
They did, yeah. That acquisition closed in September 2025. And the Shields deal is strategically really important
Why is that?
because it takes Cigna's specialty capabilities beyond just the drugs you pick up at a pharmacy. Shields specializes in the provider-administered side of specialty drugs.
Meaning drugs given in a clinic
Oh,
or a hospital.
exactly. Infusions, complex injectables, often administered by a healthcare provider, that market alone is estimated to be over $400 billion.
Wow, 400 billion.
So Shields gives them a significant entry point into capturing a piece of that massive high-growth area. It really rounds out their specialty offering.
Okay, that makes sense strategically. And it also sort of speaks to their focus on long-term durability that they mentioned, securing these major long-term renewals with huge clients like the Department of Defense, Prime Therapeutics, Centene, extending those deals way out through the end of the decade.
That's the strategic playbook right there. They clearly prioritize locking in those large, stable relationships for the long haul, even if it meant maybe not optimizing every last penny of margin in the short term.
Right. Which brings us squarely back to 2026 and those headwinds. Management said overall Evernorth operating income will likely be slightly down next year.
Draw it down, yeah.
And that entire decline is coming from the PBS segment, even while the specialty business is growing strongly. So what are the specific kind of self-inflicted headwinds causing this dip? You mentioned two.
Yeah, it really boils down to strategic investment and choices. First, as we just touched on, they accepted what they call modified margins on those three really big client renewals, DoD Prime, Centene.
Okay.
They basically acknowledge the affordability pressures those clients are under, especially the ones involved in government programs like Medicare and Medicaid.
Right, lots of budget pressure there.
Exactly. So Cigna proactively agreed to a lower run rate margin profile on those deals. That strategic choice alone accounts for more than half of the entire expected PBS decline in 2026. They chose partner stability over maximizing profit right now.
Okay, so more than half the dip is basically them giving a better deal to lock in huge clients long-term under this new, more transparent framework. What's the second piece driving the decline?
The second piece is the direct investment spend needed to actually build and implement this whole new rebate-free model.
The nuts and bolts of it.
Right. You need significant transitional investment. Think about reconfiguring all the technology systems, changing operational workflows, the massive effort of recontracting the entire network of payers and pharmacies.
Yeah, it sounds expensive.
It is. This operational investment cost makes up less than half of the total 2026 PBS decline. And they expect these costs to continue through 2027 as the rollout progresses before they really start to dissipate. They're essentially building new infrastructure for the future PBM, #TagV, Cigna Healthcare Performance and Outlook.
Okay, let's shift gears then from Evernorth's big strategic pivot over to the Cigna Healthcare segment. That's the 40% chunk of the earnings pie, the traditional insurance side. Their third quarter medical care ratio, or MCR, came in at 84.8%. Can you quickly remind us what MCR means?
Sure. The MCR is just the percentage of the premium dollars an insurer collects that it actually spends on medical claims and healthcare services for its members. So an MCR of 84.8% means that for every dollar Cigna Healthcare took in as premium in Q3, about 84.8 cents went directly back out to pay for doctor visits, hospital stays, prescriptions, that sort of thing.
Got it. And that 84.8% was a little higher, partly because of something with risk adjustment in the individual exchange business.
That's right. They mentioned an updated view on risk adjustment related to the ACA marketplace plans. Because of that, and maybe some other trends, they now expect the full-year MCR for 2025 to land at the higher end of their original guidance range, so somewhere between 83.2% and 84.2%.
Okay. We also heard some positive news about their stop-loss business. That's the insurance they sell to employers who self-insure their own health plans, right?
Exactly. Stop loss is basically insurance for insurance, covering those self-insured employers against really catastrophic, high-cost claims for individual employees.
And how's that doing?
It's tracking well. They had put in some corrective actions and repricing initiatives earlier in 2025, and management sounded quite positive. They actually expect margin expansion in the stop-loss business heading into 2026.
So that's a nice little tailwind for the healthcare segment.
Definitely helps offset other pressures.
Now, of course, we have to view these Cigna Healthcare results knowing they completed a major divestiture earlier this year.
That's true. The sale of their Medicare Advantage business and some related units in that transaction with HCSC, It did reduce their total medical customer count by about 5% compared to last year.
So membership is down slightly year over year because of that sale.
Correct. But the underlying performance of the remaining Cigna Healthcare business seems pretty healthy. And looking ahead to 2026, they're actually projecting operating income for this segment, Cigna Healthcare, to grow towards the higher end of its long-term target range.
So strong growth expected there, helping balance the temporary dip in PBS.
That's the plan. Hashtag Savviness. Capital and final thoughts.
And just to quickly wrap up the financial picture, their capital position looks solid. Operating cash flow in Q3 was strong at $3.4 billion. The main change on the balance sheet was the debt-to-capitalization ratio. It ticked up a bit to 44.9%. Right, and that increase was pretty much expected, wasn't it? It directly reflects the debt they took on to pay for that Shields Health Solutions acquisition we talked about earlier.
Exactly. That was the primary driver. They're managing it, though. They talked about balancing their capital deployment priorities, continuing share repurchases, but also making progress on bringing that debt ratio back down towards their long-term target, which is around 40%.
So deleveraging is still a clear priority.
Seems to be, yes.
Okay, so let's pull it all together. What does this all mean for you, the listener, trying to grasp the big picture here? I mean, this deep dive really seems to confirm that Cigna isn't just, reacting passively to market pressures.
Not at all.
They are actively and heavily investing both financially and strategically to fundamentally change how their pharmacy benefit services business operates. It feels like a deliberate choice to prioritize long-term durability and maybe transparency
Transparency is key.
over just maximizing the margins in the short term.
Yeah, I think that's exactly right. It's a very costly, very ambitious commitment to try and simplify an industry, the PBM industry, that has become, frankly, notoriously complex and opaque.
Largely because of those rebate structures.
Precisely. Those rebates obscure the true cost of medicines. Cigna is essentially betting that transparency, even if it means thinner margins for a year or two while they invest, will ultimately win them the market in the long run.
Okay, that sets up our final provocative thought perfectly then. Something for you, the listener, to chew on. Given that Cigna is proactively building this new business model that completely bypasses the traditional complex rebate system, will this move actually put pressure on the drug manufacturers themselves?
Interesting question.
Will pharma finally feel pressured to address, maybe even lower, the actual list prices of their brand medications, knowing that future PBMs, like Cigna's new model, won't be there to mask those high prices through hidden rebates anymore?
It really does raise that fundamental question, doesn't it? Who ultimately bears the responsibility for drug affordability? Is it the manufacturer's list price? Is it the PBM's negotiation? Is it the insurer's plan design? This move might force a clearer look at that the list price itself.
A question that, you're right, will likely define a lot of the healthcare industry debates for the next decade. We really appreciate you joining us for this deep dive.